Hi, I'm Keith McCullough. Welcome back. Today I want to tell you how to front-run the Fed. Front-run the Fed, yeah. I'm going to give you math, I'm going to give you a little behavioral, and I'm going to give you a little history. So again, the fulcrum points of the Hedgeye process. So let's first just focus on the math, straight up. It's called the correlation risk. So what you can see here is the inverse correlation on a 30-day basis between the S&P 500 and the US dollar being minus 0.86. Now again, a full 1.0 minus 1.0 would mean that they're perfectly inversely correlated. So again, minus 0.86 is very high. Now if that's not good enough for you, go to commodities. The inverse correlation on a 30-day basis is minus 0.84. And then finally, look at gold. I mean, how precious. How precious is that, Janet Yellen? The market is front-running you big time. US dollar versus gold, minus 0.93 on a 30-day correlation. So the math is clear. The market is front-running the Fed. Now, let's look at options bets. So another way to look at what we call the behavioral side of the market, which is, of course, what the Fed doesn't understand, which is called expectations. So again, and now while I'm looking at options bets, so again, CFTC, futures and options contracts, currently in gold, biggest net long position in a year, over 123,000 net long contracts for you, Janet. How about crude? Crude oil. So Putin's boys are all along this stuff, but so are the people that think that the Fed is going to devalue. So again, all-time high net long position in crude oil contracts. You got to love that. All-time, of course, is a very long time. And then finally, the net short position finally is starting to build in the US dollar. This is versus the average net long position that the US dollar has had for the last year. And again, the reason why there was a net long position was because we basically had sequestration and tapering, which are obviously bullish for the dollar. Now, just to end on that, the history of it all is very clear. This is how you front run the Fed. Number one, you got to get ahead of the fiscal side of the policy, and number two, you got to get ahead of the monetary side of the policy. So on the fiscal side, you can bet your Madoff that this government is going to try to start spending again. More spending. More spending. Bad for the dollar, particularly when you're deficit spending. That would be point number one. And point number two, which is the easy one, Janet Yellen tomorrow is going to introduce her, what she calls the qualitative forward guidance, rate guidance. So in other words, price fixing. In English, that's called price fixing. So like Japan did, she's going to try to talk down the long end of the curve or interest rates. So you, Mr. Saver, if you're one of those sneaky little savers out there, Benjamin Franklin type frugality guy, and you have a savings account, shame on you, because your rate of return is going to be zero. Obviously, these two things are very bearish for the dollar on the margin as well, and we think that the market is front-running the Fed on that. So if you have any questions, I'm at Keith McCullough. That's my Twitter handle. Please ping me.